Welcome to The Deep Dive, the show where we cut through the noise of earnings season and deliver the distilled insights straight to you. Today, we're plunging into Zoom's Q2 fiscal year 2026 earnings. And look, if you've been wondering if the pandemic darling can truly reinvent itself as an AI powerhouse, battling not just market skepticism, but the tech giants themselves, well, this deep dive is definitely for you.
Indeed. Yeah, we're seeing a pretty significant shift in the narrative here. This quarter wasn't just about meeting expectations. It was about management's very clear strategic emphasis on an AI-first approach, and also that sustained push into enterprise market. The market certainly took notice, and it seems to signal a robust, maybe evolving, but definitely robust outlook for the company.
Okay, so let's kick things off with a snapshot of the raw numbers then, because, Zoom delivered a classic beat and raise quarter. They exceeded expectations pretty much across the board. Non-GAAP EPS, which, gives us a clear picture of their core operational profitability, came in at a solid $1.53. That handily surpassed the a long $1.37 to $1.38 consensus that many were watching.
Right. And on the top line, revenue reached an impressive $1,217.2 million. That beat the $1,200 million consensus. What's really interesting here is that this marked a 4.7% year-over-year increase, or 4.4% in constant currency. But maybe more importantly, it was actually their fastest revenue growth rate in 11 quarters.
Wow.
So this isn't just a beat. It signals, potentially, a significant turnaround and some renewed momentum in their core business. It shows strong performance beyond just, easy pandemic comparisons.
Their fastest revenue growth in nearly 3 years. Yeah, that's a powerful statement in itself. So what's underpinning this acceleration then? What were the sort of pivotal shifts that really drove this strong top-line performance?
Absolutely. Well, the enterprise segment continues to be Zoom's primary growth engine. No surprise there, really. We saw revenue there increase a healthy 7% year over year to $730.7 million. Now, this is a crucial metric because enterprise now represents 60% of total revenue.
Yeah.
That's up a full percentage point year over year. And this reflects that deliberate and successful strategic focus on larger customers, moving beyond the consumer and small business market they were, initially famous for. And it's not just revenue. The number of customers contributing over $100,000 in trailing 12-month revenue, that's revenue generated by a customer over the past year, that grew by 8.7% year over year, reaching 4,274. This is a significant move-up market, and it shows they're not just landing big customers, but growing with them, too.
Yeah, that shift to enterprise is critical for stability, absolutely. But what about the online segment? That's often been seen as a bit of a post-pandemic headwind. Are we seeing true stabilization there, or is it just a slowing decline?
That's a good question. The online business is indeed showing positive signs of stabilization rather than, say, continued significant contraction. We saw 1.4% year-over-year growth. Now, that's modest, sure, but it's an improvement. More importantly, average monthly churn held flat at a low 2.9%.
Okay, that's low.
It is. And management expects a recent price increase for their monthly Pro SESC-U, that's their professional tier subscription, to add an incremental $10–15 million in revenue this year. And they noted very little customer pushback on this. They attributed that partly to the added value they've built into the Zoom Workplace suite, making that price point feel, more justified.
Right.
So while it's not a hyper-growth area anymore, it's becoming a more predictable part of the business.
Okay. So stability in online and strong growth in enterprise. But, to fuel expansion, especially in a competitive tech landscape like this, financial discipline is paramount.
Yeah.
How did Zoom manage its margins this quarter? Were they keeping costs in check?
They absolutely demonstrated some impressive financial discipline. Non-GAAP gross margin expanded to 79.8%. That's up 128 basis points year over year.
Yeah.
And for those not deep in the weeds, a basis point is 1/100th of a percentage point. So that's a notable improvement, driven primarily by ongoing cost optimization efforts in their infrastructure. Non-GAAP operating margin also saw a significant improvement, reaching 41.3%. That's up 216 basis points.
Wow.
And this translated into incredibly strong free cash flow, which grew an impressive 39% year over year to $508.0 million. With a free cash flow margin of 41.7%, that's up a full 10 points year over year.
10 points.
Yeah. That kind of margin in cash generation provides critical firepower.
That free cash flow margin is really striking. So what does a war chest of $7.8 billion in cash and this kind of cash flow generation really enable for Zoom's future, especially as they pivot to AI?
Oh, it's vital. Yeah. This financial strength isn't just, good housekeeping, it's a strategic asset. It allows them to invest aggressively in product innovation, particularly in AI, without needing to seek external funding or, dilute shareholders. It gives them the flexibility to maybe acquire smaller companies, attract top talent, and weather any unforeseen macroeconomic shifts. It's essentially the fuel for their AI-first strategy. It ensures they can execute on their vision without constraint.
Okay, speaking of that AI-first strategy, it was definitely a central theme of the call. We hear AI everywhere these days, but what does it actually look like in practice for Zoom? Is it just a buzzword, or is this truly transformative? Or maybe just a marketing play?
Yeah, no, this is where it gets really interesting, I think. Zoom's strategy seems to be about embedding advanced AI across the entire product suite to create a more integrated and intelligent experience, not just, adding a few shiny features. We heard about Zoom Docs integrating generative features. That's AI that can create content, like drafting agendas or summarizing notes right within documents. Then there's AI-powered call summaries for Zoom Phone and the custom AI companion add-on. What's truly fascinating here, and maybe suggests real user adoption beyond just marketing hype, is that AI companion monthly active users have grown over 4 times year over year.
4 times, wow.
Yeah, so this isn't just about meeting summaries anymore. It's moving towards meeting prep, post-meeting task management, and leveraging what some are calling agentic AI capabilities.
Okay, you mentioned agentic AI. For our listeners, maybe break that down a bit. What's the key difference between that and the more common generative AI we hear about, like ChatGPT? And are there any concrete examples of this in action beyond just the internal metrics, I mean?
Yeah, good question. So while generative AI creates content like text or images, agentic AI takes it a step further. It can actually understand intent, plan actions, and execute tasks autonomously.
Right.
Or semi-autonomously.
Oh, okay.
Think of it as an intelligent assistant that doesn't just give you information, but does things for you.
Right.
And we're seeing tangible results. A Fortune 200 U.S. tech company, for example, deployed Zoom Custom AI Companion for nearly 60,000 employees. Their goal was apparently to streamline IT service operations by tapping into company knowledge during meetings, generating action-ready summaries, and integrating directly with their existing AI bot.
Okay, that makes sense.
Then there's the Virtual Agent 2.0, an agentic AI solution launched just in Q2, which already has some early success stories. For example, Secure One, a private security company, replaced an expensive manual answering service with the ZVA, the Zoom Virtual Agent for Voice. They reduce costs by tens of thousands annually and enhance sales prospecting through intelligent automation.
Yeah.
So these are real-world, tangible benefits showing measurable ROI.
Those are powerful examples, yeah. AI moving from just a concept to actual concrete impact. But Zoom's ecosystem expansion, beyond just the core meetings platform also really stood out, particularly in some of their newer departmental solutions. It kind of feels like they're moving from being a sharp, reliable pocket knife to, a fully loaded multi-tool for the enterprise.
That's a perfect analogy, actually. Yeah. Zoom Phone, for instance, continues to sustain mid-teens annual recurring revenue growth. That's the predictable revenue from subscriptions, and gain market share. They even secured a major 5-year, 7-figure AR deal displacing Cisco. And that deal also included their broader workplace and contact center elite solutions.
Displacing Cisco is a big deal.
It is. This isn't just about winning new deals. It's about ripping and replacing incumbents. The contact center segment saw remarkable growth, too. Customers exceeding $100K in ARR grew 94% year over year to 229. And management highlighted that their top 10 contact center deals were all displacements of leading competitors. And critically, most were cloud displacements.
Wow. Displacing giants like Cisco and other legacy cloud providers is really no small feat. What's their secret sauce here? How are they winning these pretty high-stakes deployments?
Well, it seems to come down to maybe 3 things. A modern, more agile solution, advanced AI capabilities baked right in, and a truly integrated customer experience. Unlike older, sometimes more fragmented systems, Zoom offers this unified platform that theoretically reduces complexity for IT and enhances the user experience.
Right, that better together story.
Exactly. That story, where phone, contact center, and meetings all work seamlessly, seems to resonate strongly with large enterprises. And WorkVivo, their employee experience offering, also continued to shine. Customers over 100K ARR increased 142% year over year. 142%.
Yeah. And Marubeni Corporation, a large Japanese conglomerate, transitioning over 10,000 licenses from Meta Workplace to WorkVivo. That's a massive win and a clear signal of Workvivo's competitive strength.
These are definitely bold moves into these adjacent markets. Okay, looking ahead then, how is management guiding us for the next quarter and the full fiscal year? What are they expecting? And does this beat and raise reflect a sustainable outlook in their view?
So for Q3 FY26, Zoom anticipates revenue between $1.21 and $1.215 billion, and non-GAAP EPS between $1.42 and $1.44. For the full fiscal year 2026, they raised guidance across the board, now expecting revenue in the range of $4.825 to $4.835 billion, and non-GAAP EPS of $5.81 to $5.84.
Okay.
Free cash flow guidance for the full year was also raised to $1.74 to $1.78 billion. So this continued beat and raise pattern reflects pretty strong confidence in their strategic execution, even amidst, dynamic macroeconomic conditions. It tells us management feels they have a clear path forward. It's interesting, though, the CFO noted that while Contact Center, Elite, and ZVA are already contributing revenue, some of the other new AI products like Custom AI Companion and the 2.0 launch of ZVA won't significantly impact revenue until FY27. What does this sort of longer runway tell us about the monetization timeline for cutting-edge AI tech?
Yeah, that's a crucial point, and it provides important context, doesn't it? It signals that while adoption might be rapid for these new AI features, the path to significant monetization for truly transformative AI solutions often has a longer ramp-up period. It takes time.
Right.
Enterprises need time to fully integrate, scale, and really realize the value before the revenue impact becomes material on the P&L.
Yeah.
It also maybe highlights Zoom's willingness to invest for the long term, knowing that these foundational AI capabilities will likely drive future growth, even if the immediate financial impact isn't yet fully reflected in the near-term guidance.
Patience as a sign of confidence.
Exactly. Confidence in the long game.
So for those of you tracking Zoom, the big question has been, can they really move beyond the pandemic boom and solidify their position as an enterprise powerhouse? This quarter's results seem to offer some pretty compelling answers. The AI-first roadmap, as you've highlighted, it's clearly becoming a tangible strategy. It's driving customer adoption and opening new monetization avenues, especially in those high-value enterprise segments.
Exactly. And that continued shift towards enterprise customers, evidenced by that 7% year-over-year growth and the 8.7% increase in high-value customers, it provides a much more stable and predictable revenue stream. This really helps to balance the more modest growth we're seeing in the online segment, making the overall revenue profile, more resilient and potentially more attractive to long-term investors.
And in a competitive landscape, especially against the hyperscalers like Microsoft Teams, Zoom's aggressive AI feature rollouts and this platform expansion strategy seem to be proving crucial differentiators.
Absolutely.
I mean, their ability to displace established cloud contact center providers, as management mentioned, that highlights a unique value proposition that really resonates with large enterprises looking for integrated AI-powered solutions.
Absolutely. They're winning these high-stakes deployments partly due to maybe a cleaner tech stack and that consistent integrated experience, and the robust free cash flow, the healthy balance sheet, that $7.8 billion in cash. It provides ample financial flexibility for continued investment in product innovation, particularly in AI.
Yeah.
It's that kind of financial strength that allows for sustained R&D in this rapidly evolving tech landscape. And upcoming events like Zoomtopia in September, they're positioned as potentially significant catalysts for further AI-related product announcements. Investors should probably keenly watch for new KPIs related to AI utilization and attach rates. Those will be key forward indicators of how effectively these new features are being adopted and ultimately monetized.
Good point. And while their enterprise net dollar retention, the NDR, at 98%, which measures how much more existing customers are spending year over year, while that signals maybe measured expansion rather than hypergrowth right now, the company's ability to cross-sell Zoom Phone, Contact Center, and Workvivo, coupled with those AI add-ons, it provides clear avenues for continued wallet share expansion within their existing customer base.
Right. It's that powerful better together story that seems to be paying off.
Mm-hmm. All right, let's switch gears slightly. Let's talk trade ideas. This is our not financial advice segment, where we pitch an outrageous but plausible trade idea, kind of like a hedge fund analyst presenting to their investment committee. Remember, this is purely for illustrative purposes. Always do your own due diligence.
Okay, so given Zoom's clear AI-first narrative and, frankly, their impressive success in displacing legacy cloud contact center competitors, here's a thought for you. Consider a synthetic long on Zoom, specifically targeting out-of-the-money call options expiring after Zoomtopia in September. and simultaneously hedging that by a short position in a legacy UCaaS provider, one with a demonstrably slower AI adoption curve.
Okay, that's definitely a bold one. Let's unpack that for our listeners, especially those maybe new to some of these terms. What's a synthetic long on Zoom mean exactly? And why call options after Zoomtopia? And what do you mean by a legacy UCaaS provider?
Good questions. Okay, so a synthetic long essentially mimics owning the stock but using options. It gives you that upside exposure without actually buying the shares directly. We're targeting out-of-the-money call options. Those are options to buy the stock at a price higher than it is today. They're cheaper, but they offer significant leverage if the stock moves up strongly.
Okay.
The thesis is pretty simple. Zoom's AI Companion, the custom AI Companion, Virtual Agent 2.0, these are fundamentally altering the value proposition in enterprise collaboration. Management explicitly stated, remember, their top 10 contact center deals were all competitor displacements. Most were cloud displacements.
Right.
This indicates a profound underlying shift towards integrated AI native platforms that, frankly, older, more fragmented solutions might struggle to match.
Sure.
Customers aren't just looking for AI features. They're looking for agentic AI, the ability for AI to act autonomously that delivers measurable outcomes.
From a Zoomtopia angle, is that the main catalyst for this specific timing, picking options that expire after the event?
Absolutely. That's key to the timing. Management repeatedly hinted at significant AI announcements at Zoomtopia in September. That could act as a potent short-term catalyst, potentially boosting the stock beyond its initial post-earnings surge.
Okay, and the hedge, the short position.
Right, the hedge. For that, we're targeting a legacy UCaaS provider that's unified communications as a service and contact center as a service. I think essentially Zoom's older, maybe more fragmented rivals like some of the traditional telecom or older software players in that space, specifically one that seems to be struggling to integrate truly agentic AI across their offerings.
Okay.
So we short them. We're betting on two factors. First, Zoom's direct displacement impact eroding their market share, and second, potentially the higher cost of AI inferencing for older, less optimized architectures as AI becomes, table stakes. It gets more expensive for them to keep up.
Interesting angle.
Yeah, and Zoom's recent price increase on its monthly Pro XE, without significant pushback, that further supports maybe their pricing power relative to less innovative rivals. Look, this isn't a long-term pair trade recommendation. It's framed as a strategic event-driven play, leveraging the market's evolving understanding of AI's impact with a built-in hedge for, capital protection.
Got it. Okay, so just to recap then, Zoom delivered a robust Q2 FY26. They exceeded revenue and EPS expectations, raised their full-year guidance. The strategic pivot to an AI-first platform, particularly with innovations like Zoom Docs, AI Companion, and Virtual Agent 2.0, seems to be driving significant enterprise growth and market share gains, especially in that competitive contact center space.
Right. And strong free cash flow further bolsters the company's ability to invest in this crucial area. Investors should probably closely monitor upcoming announcements at Zoomtopia for further insights into Zoom's AI monetization strategy and product roadmap. What remains fascinating, I think, and maybe something for you to consider, is just how quickly businesses might be shifting their entire collaboration infrastructure to these fully integrated AI native platforms, and what that really means for the competitive landscape moving forward. Is this perhaps the turning point where the market truly separates the real AI innovators from the, let's say, AI integrators?
A provocative thought to end on. As always, this discussion is for informational purposes only, and it's definitely not financial advice. Please do your own due diligence before making any investment decisions.
Thank you for joining us for this deep dive. We always look forward to hearing your thoughts.